Number 9, developing cash flow projections. Cash flow projections will help you anticipate potential cash shortages or surpluses in the future. This can help you make informed decisions and take proactive steps to address any upcoming challenges. To develop cash flow projections, first, you have to prepare a budget. A budget is a summary of anticipated income and expenses over a period of time, usually 1 year. Large businesses complete their budgets by November of each year, so they are ready for the next year. The budget template is based on the profit and loss statement, also called income and expense statement. What do you need to get started? You need an Excel template, or you can use Google Sheets. You also need historical sales information by period, sales categories, and revenue centers. Transaction data by period, average transaction, customer counts. Where do you find this information? What are the data sources? Your POS system, accounting system, and payroll reports for some of the expenses. Preparing the budget. You have to ask yourself this question. What do you want your sales growth to be for the new year? What is a reasonable expectation? CPI, Consumer Price Index, is typically 2 or 3% per year, which is inflation 3% per year. So other questions that you have to ask is, how much did your sales increase last year over the prior year and the year before that? So you can see the trends. Do you expect the same growth this year, and why? Are you investing in marketing, and how is this going to affect your projected revenue? Other assumptions could be working on 3 different scenarios. Maybe your optimistic scenario will be your highest increase, perhaps 20% better than prior year. Moderate scenario, a moderate increase. And conservative scenario, a lower increase, perhaps just the 3% inflation expected. There is a formula to determine monthly sales. Transaction average $11. You find this information in your POS data of the prior period. So you determine this transaction average of $11. And what are some of the factors that will affect this average transaction size? One of them is product mix. Stores that have larger product mix will usually have higher ticket sizes. Demographics is another factor. Younger or on-the-go customers often spend less per visit, but they come more frequently. If you do promotions and bundling, that can also raise the average transaction amount. And seasonality around the holidays, usually there is a spike of sales of 10 to 30%. And you know all this information either based on your POS data or your own experience. The second step will be to determine the average transactions per day, and you find this information in your POS reports. In this case, we are assuming it's 121 transactions per day, and we are also assuming that you are opening 7 days a week. So you will multiply $11 by 121 transactions per day, 7 days, and 4.33 weeks per month. We calculate that by dividing 52 weeks by 12 months is 4.33 weeks per month. The total is $40,343 expected revenue if you have this data. More assumptions here. So let's talk about cost. Let's assume there are 8 store departments composed by water, juice, sugary drinks, soda, liquor, healthy snacks, frozen foods, produce, miscellaneous, and general merchandise in your store. In the second column here, you're going to see percentage of sales, percentage of total sales that each product category represents. For example, sugary drinks represents 10% of your total sales. You can find all this information in your POS data again. The third column is COGS, cost of goods sold. As you will see, every category of products has its respective average cost. How do we find the average cost of all your product categories? And we need this number because we are going to use that in our budgets. So we will use something called weighted average. And this is simply a formula that multiplies percentage of sales 3% by COGS 65%, and you will get 2%. You will do that for every row here. 10% multiplied by 75% is 7.5%. Once you complete the multiplication of all these rows, you are going to add all these numbers in the weighted average column, and you are going to find that is 57.9% by adding all these numbers. So the average COGS of all your products in the store is about 58%. Then look at your financial reports and you will see your operating expenses. We're assuming here that advertising expenses are 0.9% of your total sales, rent 4%, repairs 0.70%, salaries and wages 9.4%, other expenses 21.9%, and net profit 5%. So if you add all these operating expenses, you have about 37% of operating expenses over sales. Okay. Costs and expenses are determined. COGS, 58%. Remember, this is the average COGS of all your products in the store. And rent, 4%, payroll, 10%, and other operating expenses, 23%. You will see how we will use these numbers in the next slides, where you will look how a budget and cash flow projections look like.